Okay, good afternoon and welcome back everyone to another episode of the Market Playbook. My name is Tony Zhang. I'm the Chief Strategy Officer here at OptionsPlay. And today we're here to talk about a topic that many of you have been asking for, which is how to grow your options account in a volatile market. And I'm specifically going to hone in on one strategy that you can use during volatile markets that you can really use during any type of market, but specifically around volatile markets to help you grow your account fairly consistently. And this is a topic that I think is useful for just about any type of options investor, whether you're brand new and just getting started or you're an experienced options trader. This one strategy is one that's really suitable for a lot of different market conditions and a lot of different experience levels. Now, this is the one strategy that we use very heavily here at OptionsPlay. It is the one that I would recommend for anyone who's starting out with options trading to learn and master so that you can help sustainably grow your account. And the key word here is sustainably. And many of you here, trade options. Some of you may be newer, some of you may be very experienced. But I think the one thing as a strategist over the past 16 years that I have seen from traders is this struggle to get to that point where they feel consistent and confident in their trading. Now, many of you here trade options, so if you can relate to that, where you feel that it's difficult to get to that point, or you haven't been able to get to that point where you feel both confident and be able to be consistent in your trading, just type yes into the chat window if you can relate to that, where either you haven't achieved it or you feel that you really struggle to get to that point with your options trading. And I see a lot of yeses starting to come through. And this is very similar to what I have seen over my 16 years of trading. So while there are lots of different option strategies that you can trade, there's a reason that I gravitate towards trading this one strategy. That's why when you see me on CNBC, when you see me on Fidelity's In the Money, you see me talk about this one strategy more than any other strategy. It's because of the characteristics that I'll show you during today's session as to why this is something that this is the one strategy that I think if you are struggling to get to that consistency and feeling confident, that this is definitely the place that you might want to start, okay? And the strategy we're going to discuss and do a deep dive into today is credit spreads. So let's go ahead and get started. But before we do, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that I'm going to use during today's session as an educational session. So what I'm going to discuss today is how to grow an options account. What steps do you need to have in place in order to feel confident and get to the point where you can consistently grow your options account? Then I'm going to talk about the simple and forgiving option strategy, which is a credit spread. We're going to do a deep dive into the specific strategy. I'll do a live trading example because I think the best way to learn is always to use a real example. And then I want to specifically show you why, or rather how to understand where you can find an edge with this specific strategy. It's not just enough to say this strategy has an edge. It's important to understand why it has an edge, because that's really what I think is different between traders that are confident in their strategy and traders that jump ship as soon as the strategy starts to show some losses or go through a string of losses. You lose faith and you move on to the next thing because you don't really understand why it's working or not working. So it's really important to understand where you have an edge and how to go about finding it. I'm going to show you our real-time trading signals that allow you to find opportunities that consistently provide that edge that I'm going to teach you, and go through some real examples so that you can see more examples of what than the one that we're going to use in our teaching. And then at the end, I'll open this up for a Q&A. But the primary thing that I want you to be able to walk away from today's session is a clear understanding as to how can you gain confidence in your trading strategy and grow your options account sustainably. So let's talk a little bit about growing your options account. And, I see so many of you have joined here today. Thank you so much for taking the time out this afternoon. I hope that this is going to be helpful, regardless of whether you're a beginner or an experienced trader, to learn more about this one strategy and truly learn how to master it. But so please, for those of you that are joining, type, your name, where you're joining from around the world. Just let us know, because the one thing about this is that we're all in this together and we're all here to learn together. So it's really good to see everyone joining us this afternoon from all over the world. Most of you from the US, but a lot of you, I see the UK, I see Honolulu. For those of you in Honolulu, it's many times difficult to join our morning sessions. Belgium, Alberta, Calgary, all over the world. So all of those of you that are learning how to trade options, and you all come from different walks of life and different parts of the world, we're all joined here together because we're trying to gain a little bit more of mastery of these types of strategies. And hopefully today I'm able to provide a little bit of that today. So let's talk about, what do you need to grow an options account? So there's a few things that I think are really important. First thing is gaining confidence. This is really based on understanding your strategy. How do you gain confidence in the strategy? A lot of people think that gaining confidence means that you have to consistently trade something for years, get to a point where you feel comfortable with the performance of the strategy. But I tend to find that that's not what generates confidence in the strategy. Confidence in the strategy is based on a fundamental understanding as to why a strategy works, and also at the same time understanding when a strategy is not working and why it's not working. Because over the years, I see a lot of traders that simply just follow what someone else does. That someone else told you to buy this when this happens and sell this when that thing happens. You don't really know why. And it works for a while until it doesn't. And you go through a string of losses. And because you don't really understand why those string of losses happened, and maybe those string of losses caused a pretty big, significant loss in your portfolio, you say to yourself, this is not the right strategy. Let me learn some new strategy. I'll toss this one out. I'll learn some new one, and you do the same thing with the new one until it runs through a series of losses, and then you get rid of that one and you try a new one. If you can relate to that process, type 1 into the chat window. I know that I can relate to that process because in my early days, that's what I did. I learned from someone else. Someone else told me to do X, Y, Z, and I did it until I had a string of losses, and I kind of said, no, this is not working. And I tried to look for other types of strategies because there are infinite number of strategies out there. There's always something appealing out there that you want to learn. But I tend to find that, as I became more experienced, that it's not about finding other strategies and improving your strategy necessarily. It's about understanding why a strategy works, because when you go through those string of losses, you'll be able to better understand, okay, the market environment that I'm in is not conducive for the type of strategy that I'm trading. I can learn from that. I can adapt to that, but I'm not going to change my strategy. And that's how you gain confidence. That's how you gain consistency. And today I'm going to show you a fundamental understanding as to why this one strategy works in volatile markets and in other conditions, but specifically understanding why you have an edge using this specific strategy. The second thing is gaining consistency. This is really where I tend to find that from investors, that whenever you trade a strategy, while all types of strategies, high probability strategies, low probability strategies, all have the ability to be profitable in the long run. What differentiates strategies that have higher win rates versus low win rates comes down to the emotional aspect of things. And it's important to understand how emotions play into your success as a trader. So the strategy that we're going to discuss today, credit spreads, naturally, inherently, on its own, even without the edge that I'm referring to, generates trades that will win more than 50% of the time. Now, just winning more than 50% of the time is not enough to be profitable, and I'll show you why. But when you win more than 50% of the time, you tend to invest more emotionally into learning more and trying to improve yourself. Now, there's plenty of strategies that you can be equally profitable, if not more profitable, while only winning 30–40% of the time. But I tend to find that most investors have a tough time accepting that they're going to be wrong more times than they're going to be right. And emotionally speaking, that plays with you and plays with your ability to consistently grind and learn and improve when you're winning only 30–40% of the time. So while I still advocate for some strategies, certain times when you win that are only going to win 30 to 40% of the time because they have very strong risk to reward ratios. But I tend to find that those strategies, especially for beginners, tend to be emotionally more difficult to get into that mindset of learning and improving. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Perfect. And arguably more important than anything else is the rules that you have to have in place to prevent your account from blowing up. No matter what type of strategy you trade, low probability, high probability, great risk to reward, poor risk to reward, credit spreads, debit spreads, stocks, futures, options, it doesn't matter what you're trading. If everything you learn here today you take home, but you don't apply a disciplined approach to managing your risk, I can almost guarantee you that you will at some point blow up your account. And that is the one thing that I have seen in my 16 years of trading, is that traders that spend so much time analyzing their charts, optimizing their options trading strategies, spend all this time spending money on learning and indicators and strategies, don't take the time to learn about portfolio management and risk management and throw all of that investment and research and education completely out the door by simply trading too large, blowing up their accounts in the process of doing so, fundamentally giving up on their strategy and trying to rebuild all over again from the ground up with some type of new strategy, only to find themselves doing that same process over again, maybe a few months later, a few years later. And again, if you can relate to that, type 3 into the chat window. And hopefully at the end of today's session, I can hopefully help you prevent that cycle and get yourself onto a path of something more sustainable. Okay, so let's go ahead and talk about this credit spread strategy. Now, the reason that I want to use this one strategy, and I think for anyone who's trading options, this is the one strategy that you want to spend the time to learn how to master, because it's an income generating strategy for any mild directional view on a stock or ETF. What do I mean by that? Now, most of you, most of you probably are familiar with looking at a chart, but many of you might say to yourself, I'm not an expert on charting. I don't necessarily have a strong directional view all the time, but I can read a chart and get a general sense of the trend. I can look at a chart and say, okay, it's trending higher or it's trending lower. When you're trading credit spreads, that is all you need in order to satisfactorily trade a credit spread. Now, there are other types of strategies in terms of option strategies that just having a mild directional view is not good enough, such as buying a call or buying a put. If you want to buy a call option, you better believe that the stock is going to make a big and sharp move in a fairly short amount of time in order to be profitable. That is not suitable if you just think that a stock is trending higher. That's not good enough to buy a call option. You can only look at selling credit spreads when you have a mild directional view. If you truly have a strong directional view, so for example, earnings is coming up and you think the stock is going to beat earnings, guess what? You shouldn't trade a credit spread. You should buy a call option. You should buy a debit spread. There are strategies specific for when you think that a stock is going to make a big move in a short amount of time. But it's not very often that you come across a stock that you think is going to make a big directional move in a short amount of time. It's only small amounts of time where you might find that, which is why the vast majority of time when you're just looking at a stock and you're saying, this is trending higher, this is trending lower, all of those times you can sell a credit spread. And that's why this is the one strategy that I think everyone needs to learn how to master, because just about any chart you bring up, you'll be able to say, this stock is trending higher or trending lower, and I can sell a credit spread. Does that make sense? Please type 4 into the chat window if that makes sense to you. And the second thing that's important here is that it's a forgiving strategy. I'm going to discuss what that means, but it's a strategy that has a higher probability of profit, and that's going to help you build confidence. That's what we spoke about before. And third of all, it's a strategy that has limited risk and limited reward. So you know exactly how much you can potentially make and how much you could potentially lose before you get into a trade. So you have no excuse to ever say that I've traded a credit spread and I lost a ton of money. Because if you lost a ton of money on a trade, that's not the trade itself that was bad. It was the number of contracts that you traded was too large. And that is something that you fully have control over. You have no control over where a stock goes, but you have full control over how many contracts you trade. So if you ever say to yourself, hey, I followed someone else, or I made a trade myself and I lost a ton of money, then the only thing you can blame is the number of contracts that you traded, because that is why you lost a ton of money. There's going to be wins and losses in your portfolio, but there should never be a big loss in your portfolio because you have full control over how many contracts you can trade. Does that make sense? Please type 5 into the chat window if that makes sense to you. These strategies tell you exactly how much you can lose for each contract you trade, and it's up to you to decide how many contracts to trade. So it's fully in your control as to how much you risk on a given trade, and you should never risk more than what you can afford, and I'll discuss what that amount should be at the very end. So let's go through this example. I'm looking at EWJ, the ETF for Japan. It doesn't really matter what we're looking at right now. This is purely for educational purposes. And what you see is that EWJ is largely trending in one direction. I think everyone can agree that it's not trending higher. You could argue that it's starting to trend sideways, but I think we can all see that from a longer term chart, this is an ETF trending lower. So this is an example where I could take a look at a bearish credit spread on EWJ. So in this particular case, I'm going to go out to December. I'm going to sell the $50 call option, and I'm going to sell the $50 call option because this ETF is currently trading at $50. I'm going to sell the at the money call option, and I'm going to buy a $52 call option against it. Now, I'm going to come back as to how I constructed this, but this is just how you look at selling a credit spread. So if I just were to sell the $50 call option, I can collect $151 in premium per contract. But keep in mind that if I just sold an outright call option, granted that's a neutral to bearish view, but it has unlimited risk. So the reason that we're selling a credit spread instead of an outright call option is because we want to take on the risk profile of being short a call option, but doing so in a way with limited risk. And that's what buying the $52 call option allows us to do. So when I collect $1.51 for the $50 call option that I sell, and I have to pay 66 cents for the $52 call that I buy, that gives me a net credit of 85 cents. I take $1.51, subtract 66 cents from that, and that gives me 85 cents or $85 per contract. And there's three numbers that it's important for us to remember in order for us to understand the strategy. There is the $50 call option that I've sold, the 52 option that I've purchased, and then remember that the distance between those two strikes, the 50 that I've sold and the 52 that I bought, is $2. So I've sold a credit spread that's $2 wide, of which I'm collecting 85 cents out of those $2. That's really important. We're going to come back to this concept later. $2 wide, I collect 85 cents, which means that the remainder of that $2 is how much I'm risking, which is going to be $115. And that's why you see here on OptionsPlay, you have a max reward of $85 and a max risk of $115, because whatever the distance between the two strike prices, what you collect, the rest of it is going to be your total risk. Does that make sense? Please type 1 into the chat window if that makes sense to you. We're going to reset the number here right now. Okay, perfect. I see a lot of ones. And the other number important to understand is the break-even price. The break-even price is the strike price that I've sold $50 plus the 85 cents that I collect. So my break-even price is $50 and 85 cents. So those are the three numbers that are important to understand. We're going to look at this specific ETF, what happens after I sell this credit spread, and to understand the outcomes, because understanding the outcomes is what is going to help you understand this specific strategy. So here's a chart of EWJ. Let's say that this stock, or in this particular case, ETF, continues in the overall directional view that it's been trending in. It's been trending lower. I think it's going to continue moving lower. Let's say the stock stays below $50, which is the strike price that I've sold. In this particular case, I make a full $85 profit. So if the stock, the ETF declines down to 47, I make my $85. Now, what's really interesting about a credit spread, unlike buying a call option, or rather buying a put option, let's use that as an example, is that if I buy a put option and this ETF doesn't move, guess what? I lose money, right? Because what I paid in premium, that's going to be my loss on the trade. In a credit spread, if the stock doesn't, or ETF doesn't move, you actually still make a profit. not only do you make a profit, you make the full profit. So as long as the ETF stays where it is, which is around $50 right now, let's say the ETF just stays at 50, doesn't move. Guess what? You make the same amount of profit as if you were right on the trade and the trade went all the way down to 47, 46, 45, whatever it is. And this is really one of the benefits of one of the true benefits of selling credit spreads, is that even if the trade doesn't move in the direction expected to, you still make the full profit, the same profit as if it did move in the direction that you expected to. Does that make sense? Please type 2 into the chat window if that makes sense to you. Now, not only do you get the full profit even if the stock doesn't move, it gets even better, because even if the stock starts to move mildly in the opposite direction that you expect it to, as long as the stock stays below the break-even price, which as before we said was $50.85. Let's just draw a line here, roughly about right here. Even if the stock drifts a little bit higher, as long as it stays below that break-even price, you still make a profit. You just don't make as large of a profit, but you still make a profit. The closer it gets to that $50.85, the closer you make $0 in profit. The closer to $50, the more you make the $85 profit. So it's just a range depending on how far it gets closer to that break-even price. The closer it gets to that break-even price, the closer your profit is to zero. But you still make a profit even if the trade even if the trade starts to go against you by a small amount. And that is the true forgiving nature of this specific strategy. Now, only if the stock goes above your break-even price, above $50.85, but as long as it stays below the $52 strike price, the second strike price that you've purchased, you have some loss, not the full loss, but some loss between $0 and $115. And lastly, if the stock, in this particular case, the ETF shoots substantially higher, so maybe something happens with Japan and the markets continue to rally substantially, that's when you see that full loss if it rallies above the $52 strike price that you've purchased. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. So effectively, out of the 3 possible scenarios, once you sold the credit spread, the stock goes in the direction you expect it to, the stock doesn't move, and the stock moves substantially against you, 2 out of those 3 scenarios, you're going to make a profit on the trade. And that is why this trade is suitable for a lot of different market environments, because again, you don't have to have a strong directional view, even as long as it kind of drifts in the general direction that you expect it to. Even if the stock kind of goes a little bit against you and then starts to drift back, well, you'll still be profitable in that particular example. And that's why this is such a popular strategy. So let's break down kind of, if you find a stock that you have this general directional view on, what do you do in terms of constructing a credit spread? The optimal credit spread is to go out 45 days to expiration. And that's why I chose the December 16th expiration. And what we're going to do is you're going to sell an at-the-money call or put. In this particular case, calls are for bearish, puts are for bullish. The opposite of when you're buying, because right now we're selling. So the opposite of what you're buying, because when you buy, calls are bullish, puts are bearish. And when you're selling credit spreads, the exact opposite. Puts are bullish, calls are bearish. So what you're going to do in this particular case, you're going to sell an at-the-money call option, and that's why we sold a $50 call option. And then we're buying back a 25 delta put against it, or call or put against it. And that's what the 52 strike represents. The 52 strike represents a strike price that has only about a 25% chance that by the December expiration, the stock will be above $52. That's what delta represents. And the rule here, and the rule of thumb with credit spreads, is that you must collect at least 33% of the vertical width in order for it to be justified to sell a credit spread. What does that mean? We talked before about the distance between the 2 strike prices, 50 and 52. That's a $2 difference between the 2 strike prices. You need to collect at least 33% of that, which in this particular case is 66 cents. So what you need to make sure is that the premium that you collect on a credit spread is always equal to or greater than 1/3 or 33% of the vertical width. In this particular case, I'm collecting 85 cents, which is obviously greater than 66 cents. And that's the edge that I'm going to refer to. And I'm going to tell you why this edge is so important. But the rule of thumb that you cannot break on a credit spread is that you must collect 1/3 of the vertical width in order to sell a credit spread. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. You take the distance between the two strike prices, multiply that by 1/3, and that's the minimum premium that you need to collect on a credit spread. And I'm going to tell you why. So in our example here, we sold the $50 call option and we bought the $52 call option. That is the distance of $2. And like I said, 1/3 of that is going to be 66 cents or 67 cents to be, to round numbers. And in a spread that has a $2 wide credit spread, if you collect 67 cents, remember what I said, the rest of the $2 is what you're going to be risking. So if I collect 67 cents on a credit spread that's $2 wide, I'm going to be risking $1.33 on the back of that. That gives me a risk to reward ratio of about 2 to 1. Now, when you have a 2 to 1 risk to reward ratio on a trade, you need to have 67% of your trades to be winners in order to break even. That means if you have 2 winning trades where you win $1, you have 1 losing trade where you lose $2, you have 2 winning trades where you win $1, 1 losing trade where you lose $2, and you repeat this cycle over and over again. What do you get at the end of that? Type your answer into the chat window. What do you get if you keep winning $1 at a time twice and then losing $2? I see a bunch of zeros, right? A big fat zero. And a lot of investors ask me at this point, what's the point of trading something if you're going to get a big fat zero at the end of that? And I always tell investors to ask me this question that, most investors never even get to break even. Most investors struggle to even get to profitability. So just getting to break even in itself is a pretty big feat for a lot of traders. So remember, I said that this is the minimum requirement. And that's why I said this is the minimum requirement, is because anything that gives you, that requires higher winners in order to break even is difficult to achieve. This is the minimum that I think you should be striving for in order to get to your path to profitability. Now, this is not what I consider the edge. What I consider the edge is the example that I showed you, EWJ, which is $2 wide, right? 50 to 52, but I collected 85 cents. Now that happens to be about 42% of the vertical width. Because what happens when you collect 42% of the vertical width is that you now only risk less. You instead of making 66 cents to risk $1.33, now I'm making 85 cents to risk $1.15. Now that's only an additional roughly 20 cents in premium. To be more accurate, that's only 19 cents in premium. Doesn't sound like a whole lot, but what happens is that if I'm able to find credit spreads like the one that I did on EWJ, where I'm collecting 85 cents, roughly 42% of the vertical width, I'm only going to risk 58% of the vertical width. That puts my risk to reward ratio closer to about 1.5 to 1. It's actually slightly better than 1.5 to 1. And that's going to require only 60% of winners in order to break even. So if I have 2 winning trades where I win $1 each, I have 1 losing trade where I lose $1.50, and I have 1 winning trade that I win, 2 winning trades where I win $1 on, and I lose 1 on $1.50. If I keep doing this over and over again, guess what? Now I've reached profitability. So again, the rule of thumb here is to get minimum require credit spreads that get you to break even, but the goal is to really get yourself to a point where you're actually being profitable. And that jump is where you go from going to break even to profitability. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Perfect. And this is that fundamental understanding as to how you can gain an edge from credit spreads, is by selling credit spreads that you collect more than 1/3 of the width, preferably closer to 42% of the vertical width, because that's going to give you the edge that you're looking for in options trading. And that begs the question, how did I find EWJ? How did I find a credit spread that collects 42% of the vertical width? Well, this is really where OptionsPlay has done a lot of work to help you do that. But before I show you how to do that, I want to discuss a little bit about timing, because it's one thing to find an edge from the credit spread perspective. you can further increase your chances of profitability by timing the trades correctly. Now, here's a chart of XLC Communications ETF. And over the past, and this is from October of 2020 to the September of 2021. As you can see, over this roughly 1 year period, the ETF continues to trend higher. And what I said before stands true, which is whenever you see a stock or ETF trending higher, almost at any time you can sell a credit spread. At any time throughout this year, you could have sold a credit spread, and most of the time you would have been profitable. Even if, arguably, you sold these credit spreads at some of the worst times from a timing perspective. Let's say you sold it where I've highlighted in green here. Let's say you sold credit spreads there. You still would have likely have been profitable as long as you held this trade, because even if you sold at arguably what are some of the worst times, yes, you would have experienced some pain over the next couple of weeks as you entered this trade, but eventually the trade ended up going back in your favor and you would have been profitable. Even if, like I said, the XLC ended up at the same price that you sold the credit spread a few weeks before, you still will make the full profit. If you sold it here, yes, you would have suffered through a few weeks of pain, but eventually, even if the ETF ended up roughly the same price, you would have been profitable. So while you could have entered the credit spread at any one point and have been profitable largely throughout the year, I think we all agree that there are more optimal times to enter this particular trade, which is the fact that on a uptrend, waiting for pullbacks is your more optimal time to enter these credit spreads. Because if you enter the credit spread at these more optimal times, you would have been profitable within just a few days, could have gotten out of that trade and maybe found another trade that is more optimal and gotten in and out within just a few days. So it's not just, while the credit spread aspect of it, finding that edge from the credit spread aspect is important, you can further increase your odds of success and profitability, especially in terms of how you deploy your capital by timing this correctly as well. So whether you're in a bull market waiting for these pullbacks, or if you're in a bear market waiting for rallies. So again, in a bear market, you could have sold here, and granted, you would have probably suffered through quite a bit of pain and maybe gotten back out at some point at a profit. It is still better to wait for rallies from a timing perspective to sell into these credit spreads. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. Perfect. So we've learned about credit spreads. We've learned about how you can find credit spreads, or rather what type of credit spreads give you a fundamental edge in trading. We talked a little bit about timing. Now, these are all important factors. Now, what I realized in my years of doing this is that it's one thing to teach people this. It's another thing to actually take what you've learned from today and open up your trading platform and apply what you've learned, because there's just so many steps that I've referred to here today that you have to figure out, right? And it takes time to learn. So my job here at OptionsPlay as the Chief Strategy Officer is to try to not only teach, but also show you how to implement. And that's why we created what we call our fully automated trading opportunities report specifically for credit spreads. And it does all of the work that I just explained to you before. First of all, what it does is it finds credit spreads that only generate more than 33% of the vertical width. And when you look at our report, what you see is that there are usually typically more than a handful of opportunities that generate much closer to that 40% vertical width, sometimes even a little bit more, such as in the EWJ example that I showed you here before, where you're going to actually be able to generate 42% of the vertical width. So first of all, our report only finds credit spreads that satisfy that requirement. The second most important thing is that we're only looking for very liquid underlying symbols. And this is because in my years of options trading, in the beginning part of my options trading career, I spent most of it focused on technical analysis, fundamental analysis, screening for opportunities that I can trade options on. But most of that time, or at least more than half the time that I was doing that, I ended up with symbols that I did all this research on, finding the charts, looking through everything, and then realizing that the options weren't very liquid. I couldn't find the exact expiration dates and strike price that I wanted to trade because they weren't very liquid. They didn't trade a lot of contracts. So what I did is I basically found a way to only identify the most liquid names and filter out anything that's not very liquid. So anything that you see on our report will generate credit spreads that have at least 33% of the width and are very liquid, which means that you can fill these orders pretty much at the midpoint, if not more, no more than 1 or 2 pennies off the midpoint, so that you don't have to worry about execution. You can just take an idea and know that you can execute these trades in the market fairly quickly. And the third thing that we did here for our credit spread report is that we filtered out based on technicals from a timing perspective and only tried to identify opportunities where the timing also aligns with the directional view of the stock, which is what I was referring to here before. So while XLC could have generated credit spreads that had an advantage or an edge multiple times throughout the year, what we're really truly interested in is really these kind of few weeks within the year where the timing was actually perfect in addition to the credit spreads. Now, that doesn't necessarily mean you're going to be profitable every single time. And this is one where you would have been profitable 1, 2, 3, 4, 5, but the 6th time that you gotten in, you would have lost money on this particular trade. So this is not in any way, shape, or form guaranteeing that you're going to make a profit. This is just trying to put as many things aligned in your favor so that you have a true edge in trading these types of strategies. So our credit spread report offers everything that I taught you here today in a single package and automates everything for you. I'm going to go through a few examples. This is a report that I pulled just a few hours before. So this is from today's session. So EWJ, this is the example that I showed you before. And the reason EWJ came up is because it's in a bearish trend and it recently had a small rally. And these are the small rallies that we're looking for to try to sell into. And you would have had multiple rallies throughout the year, some of them small ones, right? And we pick up on even some of these small rallies to sell into. Our report doesn't necessarily just look for huge rallies. Even small rallies are suitable for, statistically speaking, giving you an edge from a timing perspective. That's EWJ. XLU, another one that I was looking at earlier today. Big fall to the downside, recently breaking below some major support levels, had a recent rally here. Statistically speaking, actually has a better chance of moving lower than continuing to move higher. Doesn't mean that it can't move higher, just means statistically speaking, you have a better chance for this to decline than to rally given the trend and given how far it's rallied from where it is. Texas Instruments, this is one that we've been trading recently. Trending lower here to the downside, and as you can see over the past few weeks had some significant rallies. Actually had earnings last week that reported fairly strong earnings, but what it doesn't change is the downtrend. I've noticed this in Visa, I've noticed this in Apple. These are all examples where quote unquote earnings report came out better than expected, but it's still trending lower. It doesn't change the larger fundamental picture. It just changes the short-term picture, meaning analysts kind of underestimated where earnings will be in the short run, but it doesn't change the long-term picture. And that's exactly what you see here in Texas Instruments. Despite the strong earnings announcement, traded up to the trend line, got rejected, and I think there's further downside here. So this is really one where I personally not only look at this report from a technical perspective, I also like to have a fundamental understanding of why I'm taking a bearish position in a specific stock. But this is just an example of one where I happen to have a fundamental view, and these are the ones that I personally will more likely trade. This report is helping me do my research because anything on this report, I know credit spreads are going to give me an edge. It's liquid, and from a technical perspective, it's aligned. I still like to add a little bit more of a fundamental flavor to it and understanding, but that's up to you as to what type of research you like to do in addition to that. But this is really pares down what are millions of possible trade ideas that you can have down to just a handful for you to research every single day. And this is where I do most of my screening every single day when I start my day to get a sense for where do I want to look further into a specific company, what charts do I want to look at further in order to do my research? Another one I'm going to show you here is Costco. Costco is also one that has peaked back in this year and continuing to trade in this downtrend here. And recently had a nice rally up to that trend line, got rejected, and I think there's further downside here. But I'll also give you some bullish examples here. Enphase. Enphase recently triggered a bullish example. Not many bullish opportunities in this market, I'll be perfectly honest, but as you can see, respects this trend line. And again, you don't have to have a strong directional view. You don't have to be a fantastic chartist. You just can look at a chart and say, this is a stock that's generally trending higher. And for those of you that maybe feel that you're not as feeling confident in your ability to do that, use our trend indicators. Notice how over the past 6 months or so, this has predominantly been green. It had a bit of red recently, but it turned green again. So this is one that I would say is more bullish, and you recently had a bit of a small pullback here. Statistically speaking, those are the pullbacks that you're looking for to sign a bullish opportunity. So this is one where this report is designed to really try to make your day as simple as possible. And it's fully automated for you in the OptionsPlay platform. You click on the education and resources section here on the upper right-hand corner of your OptionsPlay platform. This education and resources link will take you to the OptionsPlay hub. Within the OptionsPlay hub, you will find the credit spread opportunity report. And that's the credit spread opportunity report that I'm showing you here right now that you can use yourself to find these opportunities. It'll tell you exactly the symbol, whether it's a bullish or bearish strategy, and exactly which strike prices you're selling, which strike prices you're buying, how much premium you're collecting versus the vertical width. So if you're collecting 80 cents out of a $2 wide debit spread, that's 40% of the vertical width. And there's also some other information here, such as IV rank and earnings dates. You know, some of you may prefer to sell this going into earnings because you like that catalyst event. Some of you may not. The earnings date is there to help you filter out, whether something has earnings coming up or not. And this is all designed to try to make your research process for finding these opportunities as simple as possible so that you don't have to look at charts, bring up the OptionsPlay, calculate liquidity, look at credit spreads, figure out exactly which expirations and strike prices. It does it all for you. Now, that doesn't mean that you can't do it yourself. Many of you like doing it yourself. Many of you might pull up a stock and you take a look at Visa and you say it's not on the report. But I agree that I think Visa is trending lower here. It's been trending lower since last year. If you look at the stock here, everyone loves the stock, but the reality is that this is a stock that has declined since September of 2021. And we recently traded up this huge rally up to that trend line. And you're thinking to yourself, I think this can move lower. Well, the OptionsPlay platform will help you automate finding these credit spreads. If you click on the high implied volatility strategy, we will have both a bearish credit spread and a bullish credit spread that's fully automated for you that follows the exact best practices that I taught you. So if you want to sell a credit spread on a name that's not in our credit spread report, you can always automate that using the OptionsPlay platform as well. It's just that you then have to do the work yourself to calculate liquidity, and you have to make sure from a chart perspective that it also aligns from a technical perspective. So Visa, as you can see here, this is selling the December 195-210 call spread, collecting $5.39 out of a $15 wide credit spread. So let's just do a little bit of math. 539 divided by 1500, that's roughly 36% of the vertical width. So that satisfies the requirement of meaning 33% of the vertical width in order to trade this specific strategy. So that is the strategy itself. And this is really how OptionsPlay helps you automate this and finds opportunities as easily and as quickly as possible. And what I'll do is I'll wrap this up with my last piece, which is you can take everything that you've learned here today, and I guarantee you that it completely all goes out the door with respect to profitability if you don't follow the rules to manage your portfolio appropriately from a risk management perspective. So let's go back to our EWJ example here. I'm going to pull up the credit spread here, the 50-52 credit spread in December. And here it's collecting 86 cents. This is as of the closing price. Now, how many contracts should you trade on this? That's really where we built the risk and investment calculator. The risk and investment calculator is something that you should use every single time you place a trade. If you don't use it every single time you place a trade, and you can calculate manually, but we do it for you so that it's automated as much as possible, because the more automation you can bring to this, the less emotions that you bring into kind of your process, the more likely that you're going to stick to a trading system and a trading discipline that's going to keep you on the right side of profitability. It's when you deviate from these rules that I tend to see investors blow up their accounts. So as you can see here, the risk and investment calculator, I can just simply click on the calculate button and it will automatically tell me that I can sell 17 contracts of this credit spread. Now, why did it tell me to sell 17 contracts? Because I've already put into my profile my defaults, and you should do this too. I suggest for those of you following along, do this right now. Go to your risk and investment calculator, click on this button here at the bottom to adjust your defaults in your profile, and type in your portfolio value. I've put in a hypothetical portfolio value of $100,000. And what this does is it calculates that you should never risk more than 2% of your total account value based on your total account value. So if you have a $500,000 portfolio, put in $500,000. Put that in, save this as default. I recommend that you never risk more than 2% of your total account value on any given trade. You can watch my portfolio management webinar if you want on why the math behind 2% is so important. Some people will say, what if I go to 4%? That doesn't sound like a whole lot different from 2%. There's a world of difference between 2%, 3%, and 4%. So my rule of thumb is 2%. But you put in your portfolio value and you use the risk and investment calculator. So now, as you can see, it says that I can risk $10,000 because on a $500,000 portfolio, 2% is $10,000. So I click on calculate, and it'll say I can sell 87 contracts of EWJ. So you adjust the number of contracts based on your portfolio size, and this automates so that whatever strategy that you trade, notice how the max risk of this credit spread is $9,918. That is just shy of the $10,000 you can risk. Because if you traded 87 contracts, even if EWJ, the second you got into the trade, shoots up to $100, maybe something happens in Japan that, I don't know what happens, but Japan economy turns around, the BOJ starts to hike rates and do something that the rest of the world's not doing. And the trade completely goes in the opposite direction that you expected to. Well, guess what? You've lost 2% of your total account value. That's what you were comfortable risking. You still have 98% of your portfolio left to trade in order to get back to your break-even point. That's reasonable, and that's something that you can do. But if, let's say, on this particular trade, you just decided to roll the dice and trade something where you traded 870 contracts and risked $100,000 of your portfolio, it's not the trade that was bad. It was the number of contracts that you risked that was completely out of line for the size of your portfolio. And that's what I consistently see from traders. Traders will always say that was a bad trade. It wasn't a bad trade. It was a trade that you traded too large. That's always the problem at the back of a trade where you lost a ton of money. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. And hopefully this gives you a strong understanding of credit spreads and how to find credit spreads specifically that give you an edge that puts you on the right path of saying, okay, I have a direction that I can go in, that I can learn from, that I can improve with as I continue to optimize and trade. And you can paper trade these. I highly recommend that you paper trade these. So let's say you were going to sell 17 contracts of this December 50-52 call spread on EWJ. Click on the trade button, use our paper trading feature. Everyone has access to this in your portfolio. You have paper trading accounts. Add this position to your paper trading portfolio, and you can track these positions in your portfolio tool. This is designed to help anyone who's starting out with options trading to test out a strategy, see how it plays out without risking real capital, and seeing how these trades perform. Let me just pull up my paper trading portfolio, and I'll show you this EWJ position. As you can see, here's my EWJ position, and I can see how it's doing. So right now the P&L is 0 because the market hasn't moved, but tomorrow when I come back, you'll see if EWJ starts to decline, you'll see a profit. If it starts to rise, you'll see your loss, and you start to learn how to manage these trades and understand, hey, a trade that I've made started to work in my favor. Now it's not working in my favor, and seeing how that changes. Now, paper trading will never replace real trading. I advocate for those of you that are truly learning how to trade one contract, right? Get some skin in the game, because that's how you're truly going to learn. But paper trading is a good transition between, hey, I know nothing about options trading, I just learned about credit spreads, to placing your first trade, not risking any real capital, getting a feel for it. And once you feel comfortable enough, place that one contract trade. Even if you're just risking $115 in that trade just for one single contract, do that, because that's truly how you learn. With that, that covers what I wanted to share with you here today. I hope that this was really helpful in giving you a better understanding as to how to sell credit spreads, how to use credit spreads in your portfolio, and what you should be looking for to further improve your trading. And for those of you that are joining us for the first time, if you don't have access to the OptionsPlay platform, you can sign up for a free 30-day trial at OptionsPlay.com. You can point your phone at the QR code in the lower left-hand corner to sign up for a free 30-day trial. That will give you access to the full platform that I showed you today, and access to the credit spread report that I'm referring to that automates everything that I've taught you here today. You get access to the platform to help you find and manage these trades using the portfolio feature. Jessica and I are here every single Thursday to teach you option strategies so that you learn and continue your options education with us. And Rick posts daily trade ideas in his Monday macro session so that you get a sense for where the market is heading. We just made a huge call this week on changing the directional view of the markets. We've gotten rid of all of our long positions, and now we only hold short positions. So we're no longer playing for a market bounces here. That's a pretty shift in our directional view. Having that large directional view, bigger picture directional view, is so important for your trading. And Rick does a fantastic job on updating you on what his longer term directional view, the former chief market strategist at Morgan Stanley, is at the helm of helping you understand the directional view of the market and going through specific trade ideas every single day. He publishes trade ideas to give you how he's thinking about the markets and specific ideas that he's looking for with an options trade. We send out both opening and closing trading signals. So you get all of that for free for 30 days at OptionsPlay.com. I hope that this is helpful in giving you that understanding of credit spreads, and hopefully OptionsPlay can help you become a better trader. So with that, what I'll do is I'll open this up for Q&A. If you have any questions, there's a Q&A window. Please type your questions in the Q&A window, and I'll try to answer as many questions before I have to sign off here for today. And for those of you asking if there's going to be a recording, both the recording and the slides will be sent out to you like we do every single Thursday. You know, someone's asking about charting and forecasting. And he's asking about, is that using Fibonacci? Is that using, other indicators? I will be perfectly honest. For me, charting is really about price action. It's about looking at the price. I use a few indicators on my charts. I'm not a big fan of indicators. I'm generally speaking, if any indicator that I have, generally speaking, is an Ichimoku cloud. That's about it. And that's really designed to help give me a sense for support or resistance. I almost never use any momentum indicators. If I do, I use a CCI, and those are all designed to help me confirm timing on my price action or on my views on the stock. And then I might, the one chart that I do rely on very heavily is relative strength. And OptionsPlay actually provides the relative strength ranking for any single stock. So as you can see, the relative strength of Apple is 5, meaning it's basically performing on par with the market. It's not outperforming the market. It's not underperforming the market. It's performing on par with the market. Versus if I look at something like Zendesk, it's got a score of 2. That means it's underperforming the market, meaning as the market drops, this drops even further. And if you find a stock that has a strength of, let's say, 7 or 8, like Planet Labs, let's look for something that perhaps is something that we all, NextEra Energy, strength of 8. This tells me that this is outperforming the market, meaning as the market drops, this stock doesn't drop as much. So this is really how you can get a sense for strength. Strength is a very important aspect in my charting outside of looking at the chart itself, because I want to know if the chart is underperforming or outperforming the market when I'm looking at bullish or bearish opportunities. Do I think iron condors may be better than credit spreads. So the iron condor means that you have to have meaning if the stock moves in the direction of you that you expect it to. Well, here's the problem with iron condors, and I'm not saying you can't trade iron condors, but if the stock or ETF you trade moves substantially in one direction or the other, you'll see losses on both sides. I tend to find that if I ever am in an iron condor, I'm in an iron condor because I entered the call and the put side separately. Meaning, let's say that this is not a particularly great stock for an example because it's not really trending in one direction. But let's say the stock was trending lower. I might be inclined to sell a call credit spread up here, and then a few days later, as it declines here, I might be inclined to sell a put credit spread here. And by doing the call and the put separately on maybe a week apart, I might end up in an iron condor, but I didn't trade this as an iron condor to begin with. I ended up in an iron condor, but I didn't seek out to trade an iron condor. That's how I typically use them. I typically don't trade iron condors as a strategy itself. Someone asking about how many contracts should I trade, that's really where you want to use the risk and investment calculator. How many of you have used the risk and investment calculator? Type yes into the chat window if you have, and type no if you have not. I know I've been talking about that for a long time, so I know many of you have, and I see a lot of yeses, but I also see a lot of no's. If you have not used the risk and investment calculator, go into your profile right now, set your settings, and make sure you use that every single time you place a trade. This is how you're going to stay out of trouble, and this is how you're going to never, ever come into a point where you're going to say, I lost a ton of money on that trade because that was a bad trade. It wasn't a bad trade. You traded too many contracts. Remember that. Volatility is still a mystery. Please explain how volatility affects credit spreads. So volatility affects credit spreads in two different ways, because you're selling one and you're buying another credit spread. You're selling one option contract and you're buying another one. What you want to find is in an ideal world, and that's exactly what our credit spread report does, is it finds a strike price where the implied volatility is relatively high, and then when the strike that you're buying, the implied volatility is relatively low. And this is what we refer to as skew. When the skew is steep and in your favor, that's really when you tend to find credit spreads that collect that 42% of the vertical width. When the skew is working against you, meaning the options that you're selling, the vol is relatively low, and the option that you're buying is relatively high, that's when you're going to find credit spreads that are closer to 33% or even below 33% of the vertical width. So volatility affects the premiums that you're collecting and the premiums that you're paying, and the better that they're skewed in your favor, the more favorable the outcome is for you. So our platform is trying to find those opportunities where the vol skew is most in your favor. So Dominic's asking, if 1/3 is the minimum, so what's the maximum you should pay for the buy side? So Dominic, when I'm referring to 1/3, that's the net that I'm referring to. It doesn't really matter what you're paying and what you're buying. What you're just caring about is the net between the two. So the net between the two has to be 1/3 or greater than 1/3 of the vertical width. Can you please help interpret higher premium with 40 with a lower IV rank? So IV rank is a generalization. What you want to care more about is the vertical width more so than the IV rank. IV rank might be something that you might use as a tiebreaker between two that has a very similar vertical width, right? So if you look at SPY and XLU, they virtually both collect about 39.5% of the vertical width. I might be more inclined to go with SPY because it has a higher IV rank. But other than that, premium versus width is always going to be the most important indicator or the most important column for you. Let's see, where did the Q&A window go? Here we go. In your experience for additional income, is it a good idea to transform the initial credit spread into an iron condor? You can, absolutely, because the thing about selling an iron condor is that you can collect more premium without adding any additional risk or adding a higher margin requirement if the other side is the same width or less. That is a tactical thing, right? So when I say that this puts you on the path to profitability, There are things that you can do to further increase your chances of profitability, such as turning a credit spread into an iron condor. But that's a more advanced topic for us to discuss today. But for those of you that understand what I just said, absolutely, that is the next path forward in terms of potentially even further improving the success of this strategy. Can I move the strikes of my credit spread slightly out of the money and get closer to 1-to-1 payout, preferably if my break even is still well within the money? If you move your credit spread slightly out of the money, then you're not going to get anywhere close to a 1-to-1 payout. You're going to get maybe a 3-to-1 payout. So you're going to risk $3 for every $1 you can potentially make. I'm not a big fan of that. I know there are traders that do that. I'm not a fan of it. You do have higher probability of profit, but that's traded off with a really poor risk to reward. So you're not going to get something, you're not going to ever get a 1-to-1 payout on a credit spread, unless it's an in-the-money credit spread, which I also don't recommend. Does 45 days expiration for credit spread seem too far out in a volatile environment? No, because the credit spread, what you're caring about a credit spread is really, and keep in mind, volatility works in both directions, right? Because volatility is not a directional bias. So if volatility is high, keep in mind that we're naturally adjusting the strike prices for volatility. So the implied volatility of an option is something that we use to determine the strike prices. So we're already naturally adjusting for a higher vol market when we choose our strike prices. That's why we use a delta-based approach to select our strike prices. So no, I would not use a shorter dated expiration credit spread for a more volatile market. You're absolutely right. 42 is very rare. 40% is usually the top end of the report. 42 is quite rare. So the reports are generated once an hour. I tend to find that this is something that's enough for us to find opportunities. Occasionally, you will find that by the time you look at it, that opportunity is no longer presenting itself. These opportunities, generally speaking, are good for at least a single day for the most part. So updating every single hour finds new opportunities that are relevant. I tend to find that once an hour delay hasn't been an issue in my opinion. But what you should do is make sure that when you place the trade, that you're still collecting close to that 40% of the vertical width. If let's say by the time you look at the trade, it's now only priced at 33% of the vertical width, that might be one that you might want to pass on. For those of you asking about election risk, I highly recommend you watch Rick's session next Monday, where he's going to be talking a lot about that. How to navigate this current bear market that we're in. Like I said, the rejection at 3,900, rejection on that daily cloud model was the impetus for us to turn fully bearish here in the broader markets. We got rid of all of our long positions, and we're now only short in the current market right now. So Rick is fantastic at helping you navigate kind of where the broader market is heading, and giving you a good sense for that so that you can lean more bearish or more bullish. But this week was a pretty pivotal point where we did change our tone on the broader markets. There's a couple of questions regarding when you should get out of a credit spread. I could probably do a whole lesson just on that alone, but the general rule of thumb is that if you can make 50% of the max profit, it's time to get out of the credit spread. Once you've lost 100% of the premium that you've collected, it's also time to get out at a loss. And the other rule of thumb is that you want to exit at 21 days to expiration. If it doesn't reach your take profit or stop loss, but it reaches 21 days to expiration, it's also time to get out of the credit spread. That's to help avoid this early assignment risk, because you don't want to be assigned early or assigned, generally speaking, on a credit spread. So that helps you avoid that early assignment risk. The 2% per trade is referring to 2% per security. But you generally also don't want to stack 20 open trades, all risking 2%, because then you're truly risking 40% of your total portfolio value. You do have to consider kind of the makeup of the positions that you have. If you have all short positions, then you're fairly concentrated in the short. If the markets has a strong rally 1 month, you can see all of your short positions losing. So you have to factor that in, because that's why I advocate for most investors to have some level of diversification, some long, some shorts, different sectors. That's going to help you prevent, where the market moves up a single month and wipes out all of your positions because you're all short in one particular sector. If you have more diversification where you have a combinations of longs and shorts across different sectors, then if some months markets move higher, some months markets move lower, you always have some positions that are going to offset each other, some winning, some losing. How do you place a stop loss on a credit spread? That depends on your broker. I use Thinkorswim, and I've actually recorded a video that you can find on YouTube for finding how to place a stop order on a credit spread on Thinkorswim. But that is a question for your broker. Your broker will, first of all, tell you whether or not they support stop orders on a credit spread, and if so, kind of how to go about placing that. What is the minimum account value needed to trade options? Well, there's a theoretical limit, which is $2,000, because that's the minimum to have a margin account. And there's a more practical limit. I tend to find that with these types of strategies, you need at least about $5,000 to practically trade these. Are you saying that the risk percent as a percentage of strike width needs to be smaller than pop? Not sure I understand your question. No, David, just that you don't want to risk. No, it's just saying that you generally want to risk no more than 67% of the vertical width. That's it. Can we have the same webinar for debit spreads? Absolutely. I will prioritize that in the calendar for probably late November, early December. Thank you so much for that suggestion. How do you decide on partial closings of a position? So partial closings is, generally speaking, something that we do more so on the take profit side than we do on the stop loss side. Once a trade goes in the opposite direction that you expect it to, we generally like to just cut the full position. But when a trade is starting to go in your favor, you can take partial profits, meaning once it hits your first target, take half the position off and try to keep the other half where you can try to make the full profit. That's really kind of how we think about partial closings on a position. How do you address managing assignment risk? Well, having a take profit, having a stop loss, and having that 21-day rule to expiration, if you stick to all three rules, meaning taking profits when you should, cutting losses when you should, and exiting your trade at 21 days to expiration, theoretically, you should never have an early assignment on a credit spread in that particular example. Because one of those three triggers should have hit well before you're ever in a position where you are assigned early on a trade. Ultimately, you can never 100% remove early assignment risk, but you can virtually eliminate it by following those rules. How does earnings affect the credit spread that you post daily on OptionsPlay? It doesn't. The only thing it does is it accelerates the event at which you can potentially take profits or cutting losses. Otherwise, it doesn't change anything else. What is the minimum account size? We just talked about that. Your question about XND, volume and open interest is not a good gauge for liquidity. Bid ask is much, much, much better. I traded XND quite a bit, and I'm able to, what I care about is whether or not I can get filled at the midpoint or very close to the midpoint. And what I have found in XND is I can get filled very close to the midpoint, and that's really the most important thing when measuring liquidity. Open interest, bid ask prices, none of that really matters if you can get filled at the midpoint. Daniel, I'm not sure what you mean by iron condos just have one price level to maintain. Iron condos have two price levels that you have to maintain, and it has to stay within those two levels versus a credit spread. You only have one break-even price that you really have to maintain. So iron condors adds that complexity where you have two prices that it has to stay within that price in order to be profitable. Judy, I use this report and it really saves me time, but I have an additional question. On the platform, when you adjust backward the expiry date to 21 days, back the profit risk reward ratio changes quite a bit. Judy, I'm not sure I understand what you mean by that. What if half the trade is assigned? So in theory, you could always be assigned for a partial amount of the trade. I tend to find that if you get assigned early, exit the stock position that you're in, because you don't want to be exposed in the stock. And plus, you'll only be assigned on half the short contracts. You can't be assigned on the long contracts. So the long contracts are still there to protect you. So even if you get assigned on partial position, as long as you don't hold it past the expiration date, the risk doesn't change. So, and that's another clarification. If you get assigned early on a credit spread, as long as you don't hold the stock position past the expiration date, your risk actually is still the same, even though you've been assigned early. Generally speaking, you don't want to hold on to that stock position. You might probably want to exit, the long leg and the stock position. But if you did hold on to it, the risk doesn't change. That, unfortunately, is all the time that I have time for here today. I really went a little long during the session because I really want to do that deep dive. I hope that this was helpful in giving you a better understanding of credit spreads, how to find them, how to find an edge, and really how to put yourself onto that path of profitability and gaining more confidence in your trading. And that I know a lot of traders, find it tough to kind of get onto that path. So with that, thank you so much for your time this afternoon. We will send you both the recording and the slides after we finish here today. And I hope that for those of you that are new, signing up for this free trial allows you to access the tools that I showed you here today. Thank you so much and have a great trading day.